Good morning, everyone. Welcome to our Phillip Securities Research morning call. For today, we have results for Big Tech, UOB, as well as Sheng Siong. And we also have update for Keppel Corp, Phillip on the ground for IFAST and Suntec REIT. For technical analysis, we have it for Straits Times Index, S&P 500, and CapitaLand Escort Trust. And we also have Singapore Weekly for week 44. So without further ado, let me hand over my time to Jonathan.
Thanks, Zane, and good morning, everyone. So for today, I'll be covering Netflix's third quarter results, titled Re-Acceleration in Membership Growth. Right, so overall for Netflix, their third quarter revenue beat expectations, even with a 7% FX headwind. Earnings also beat by 45%. Their year-to-date revenue and PATMI is at 73% and 82% of our full year forecast. Earnings beat mainly due to a $348 million US dollar debt remeasurement, euro debt remeasurement, and about a $200 million US dollar shift in spending from the third quarter to the fourth quarter of this year. Membership additions also beat expectations with 2.4 million additions versus 1 million expected. So for the positives, there are three main positives. The first is the outperformance in membership additions. Like I mentioned, 2.4 million additions versus 1 million expected. So the additional 1.4 million additions, most of it came from the Asia Pacific region, which grew 23% year on year. Also comes as kind of a relief after two consecutive quarters of membership losses, signaling a potential turnaround in membership growth for Netflix. The second positive is that their earnings and revenue beat for the quarter. Third quarter revenue of $7.9 billion US dollars beat guidance marginally. Most of it is mainly due to the outperformance in membership additions, so they just have more members, more subscribers, leading to more revenue. In terms of revenue from regions, the revenue from UCAN, which is its most mature market, grew 11%. This was driven mainly by 12% year-on-year growth in prices. In terms of earnings, $3.10 of EPS also beat guidance by 45% on the back of higher revenue, a shift in spend, and the debt remeasurement. So if you exclude the FX debt remeasurement, earnings were beat by around 15%. The last positive is that the Netflix is actually seeing really strong initial demand from advertisers for its new ad-supported plan. They're actually planning to roll this out in November to 12 countries at a $6.99 price point. This is actually several months ahead of schedule because they were actually expecting to roll it out in the first quarter of next year. The company stated that initial demand from advertisers was really strong, with advertising inventory almost sold out. And Netflix also expects this new plan to be margin accretive and should lead to significant incremental revenue and profits moving forward. In terms of the negatives, a stronger US dollar is expected to continue hurting both top and bottom line growth for the fourth quarter of this year. In terms of revenue growth, we expect it to hurt by about 9%. And we also do expect effects to affect operating margins negatively by about 4%. Next slide, please. In terms of outlook, Netflix actually guided to fourth quarter revenue of about 7.8 billion, which represents about a 1% year-on-year growth, or 9% year-on-year in constant currency. The company also guided to 4.5 million additions for the fourth quarter, compared with 8.3 million in the fourth quarter of last year. Net margins are also guided to be around 2%. And this is quite typical for the fourth quarter because there's a higher level of content spend associated with a larger content release date in the fourth quarter. In terms of valuation, we actually lowered our FY22 revenue and PATMI forecast by 3% and 17%. on the back of slightly higher expenses and larger FX headwinds. We do maintain a buy recommendation with a lower target price of $346 US with a WACC of 2% and an increased terminal growth rate of 3%. So that's all for Netflix. Moving on to Alphabet. They also announced their third quarter 2022 results, and the title for the report was challenged by pullback in advertising spend. So in terms of results, their third quarter results missed on both revenue and earnings, with year-to-date revenue and PATMI at 68% and 50% of our forecast. Revenue missed mainly due to an incremental pullback in advertising spend as well as FX headwinds. Net margins were down 9% year-on-year to about 20%, mainly due to increasing operating expenses and FX headwinds. There's only one positive for Alphabet, and that has to do with cloud. So Alphabet is actually seeing continued momentum in Google Cloud, with cloud being the company's fastest growing segment still, growing at about a 38% year-on-year increase. And they posted revenues about $6.9 billion US for the quarter. Growth in cloud continues to be driven by increasing cloud adoption and cybersecurity needs, as businesses look to reduce IT costs and digitalize. In terms of the negatives, both revenue and earnings miss on a pullback in ad spending and FX drags. Revenue for the quarter came in at $39 billion, which equates to a 6% year-on-year increase, its lowest revenue growth rate since 2013. It was also hurt by a 5% FX headwind and a pullback in advertising spend. In terms of net margin, was down, like I mentioned previously, down to 20%, hurt by increasing operating expenses. This is mainly because headcount growth grew 26% year-on-year. Net margins was also affected by a $3.5 billion US fluctuation in unrealized losses in equity and debt investments. The other negative is FX continues to drag, and we expect this to increase for the fourth quarter of this year. And we do expect this to have a greater impact on bottom line growth compared to top line, mainly because the percentage of expenses incurred in US dollar is higher than the percentage of revenue incurred. Revenue and earnings growth is also expected to be weak compared to a very strong fourth quarter last year, where we saw a really big rebound, adding to further growth headwinds for the fourth quarter of 2022. In terms of the outlook, we expect revenue growth to be around 6% year-on-year, mainly due to tough comparisons and a very uncertain macro environment. We do expect net margins to be around 22.6%, which is down about 5% year-on-year. In terms of YouTube Shorts, which is the company's short-form video app or product, Shorts continues to see great user momentum with 1.5 billion multi-active users and about 30 billion daily views. Shorts viewership as a percentage of total YouTube watch time also continued to increase. In terms of valuations, we cut our FY22 revenue and PATMI by 6% and 20% to account for a pullback in advertising spend, higher than expected operating expenses, increasing FX headwinds, and unrealized losses on debt and equity investments. We maintain a buy rating with a lower target price of $124 US, with a WACC of 7.3% and a terminal growth rate of 3.5%. Moving on to Meta Platforms, who also announced their third quarter earnings. The title for the report is Rising Expenses Continue to Weigh on Margins. So for Meta, in terms of results, their third quarter revenue was in line. However, earnings missed by 12%. The year-to-date revenue and PATMI is at 68% and 60% of our forecast. For the positives, there was only one positive, and that has to do with Reels engagement. Reels engagement continues to see momentum, and is actually gaining time spent share on competitors like TikTok. So Reels actually saw more than 140 billion daily plays, which represents about a 50% increase from 6 months ago. The kind of downfall with Reels growth in the near term is that because it doesn't really monetize as quickly as feed or stories, every incremental revenue growth kind of slows down, or rather, every incremental viewership growth actually reduces revenue growth. But we do expect this to even out over the next couple of years, especially as monetization for shorts, for reels improves. The last 12 month revenue run rate for reels was about 3 billion in the third quarter of this year, 3 times more than the second quarter of this year. Moving on to the three negatives, earnings was cut in half, mainly due to a jump in expenses. So if you compare $1.64 for its earnings, that was about 50% lower than a year before. The main reasons were 5% year-on-year revenue contraction and a 19% year-on-year increase in expenses. In terms of expenses, R&D saw a 45% year-on-year increase as Meta continued hiring technical roles to support its family of apps segment. Second negative is that Reality Labs, which is its VR and metaverse kind of segment, continues running deeper into the red. Reality Labs was down about 49% year-on-year as a result of slowing Quest 2 sales. So Quest 2 is their VR headset. Expenses remain high, with operating loss for the segment at up 40% year-on-year. Operating loss year to date for Reality Labs is about reaching almost $10 billion for the year so far. So continued losses from Reality Labs is somewhat concerning, given the uncertainty surrounding its timeline to profitability, as well as a growth stagnation in Meta's core digital advertising revenue. So for the last negative, Meta actually guided to another quarter of negative revenue growth. So they actually guided to a revenue range of 30 to 32.5 billion US dollars, which represents about a 7% year-on-year contraction, taking the midpoint. This is also factoring in an approximate FX headwind of about 7%. So we think that the sluggish guidance reflects continued weakening trends in digital advertising and an uncertain macroeconomic environment. In terms of the outlook, the company actually, like I mentioned previously, the company actually guided for 7% revenue contraction. In terms of operating expenses for this year, Meta guided to this total expenses to be in the range of 85 to 87 billion US dollars. They actually lowered the top end range from 88 billion dollars to 87 billion dollars. They also guided for next year's total expenses to be in the range of 96 to 101 billion dollars, which represents about a 15% year-on-year increase. We do actually expect higher expenses to continue weighing on margins. And we forecast FY22 net margins to be around 21%, down from our previous estimates of about 25%. In terms of valuation, overall, revenue expectations for this year remain weak due to a weak macro environment, uncertainty surrounding the potential bounce back in advertising spend. We do also expect elevated expenses to place downward pressure on margins. Because of this, we cut our full year FY22 revenue and PATMI forecast by 7% and 23%. We do also cut our FY23 revenue and PATMI forecast by 3% and 23% to reflect our assumptions. We downgrade Meta to a accumulate rating with a lower target price of 113 US dollars, with a WACC of 7.3% and a terminal growth rate of 3%. So that's all for me. I'll pass my time on to Ambrish for Microsoft. Thank you.
Thank you, Jonathan, and good morning, everyone. So today I will be sharing about Microsoft's first quarter 2023 results, and the title of the report was Azure Drives Growth Despite Currency Headwinds. Next slide, please. So overall, the results were in line with our expectations. The first quarter revenue and PATMI, it came in at about 23% of our full year 2023 forecasts. In the first quarter, the total revenue grew by about 11% year on year to 50.1 billion US dollars. And if excluding the foreign exchange headwinds, it grew by about 16% on a constant currency basis. Meanwhile, PATMI fell by about 14%. This was mainly because of a one-time tax benefit of 3.3 billion US dollars in the year ago quarter. And if we exclude this tax benefit, then the normalized PATMI growth would be about 2% year on year. Moving on to the positives. First of all, the strength in cloud computing services, it continued to drive growth for Microsoft. In the first quarter, Azure's revenue, it grew by about 42% year on year on a constant currency basis, which was about 1% below the company's guidance. The significant growth was mainly because of surge in Azure contracts, mainly because the companies, they seek to digitize operations and reduce costs. The strength in Azure, it helped to drive its cloud segment revenue, mainly the intelligent cloud. It grew about 20% year on year to $20.3 billion US. Secondly, the demand for its productivity software, Office 365, it remained strong. The Office 365 commercial revenue, it grew by about 17% year on year, and mainly because its number of users, they grew about 14% year on year. Additionally, the average revenue per user, it also grew, mainly due to the strong adoption of higher end E5 licenses. Moving on to the negative, Windows OEM revenue, it fell by about 15% year on year. So this segment, it basically is a licensing revenue. It gets from the PC manufacturers like Dell and HP. They install these Windows operating software on their machines. So the significant drop in this particular segment was mainly because of weak demand for personal computers. So moving on to the outlook. Next slide, please. In the second quarter, Microsoft, it expects to generate revenue in the range of 52.35 billion to 53.35 billion US. This suggests a growth rate of about 1% to 3% year on year. Further, the management, it said that it expects Azure revenue to decline by 5%. So it indicates a growth rate of about 37% for second quarter. And the decline, it's mainly because of cost optimization and macroeconomic pressures, as mainly the customers, they have paused their spending. Additionally, the Windows OEM revenue is also expected to fall by about 30% in the second quarter. So Microsoft, it also generates 50% of its revenue outside the US. And as a result of strengthening of the US dollar, the forex headwind, the company said that it's likely to hit by about 5%. In terms of its full year forecasts, full year 2023 forecast, the company, it reiterated its revenue and operating income guidance, like they would grow by about double digits on a constant currency basis. Meanwhile, the commercial revenue is expected to grow by about 20% year on year. And this indicates that Azure's growth would stabilize later in the second half of 2023. In terms of its valuations, we have reduced revenue and PATMI by 2% and 3%, mainly to account for negative foreign exchange headwinds and weakness in the PC market. We have reduced our target price to $319 US. And overall, we believe that it is well positioned due to the digital transformation trends and cybersecurity upgrades. So that's all for Microsoft. I would now like to pass on to Max for Amazon.
Thanks, Ambrish. So Amazon also released its third quarter 2022 result last Friday, and our report was titled Effects Inhibiting Revenue Growth. Next slide, please. So the results were mixed. Amazon's 9 months revenue is actually in line with our expectation, reaching 69% of our full year 2022 forecast. But its normalized PATMI, which is PATMI excluding the effects of non-operating income like its Iridian and other equity investments, came in at 47% of our full year 2022 forecast. The company achieved $127 billion US in revenue, which signifies a growth of around 15%. And it normalized PATMI came in at $2.1 billion. Operating margins were at 2%, which is actually a decline of 2.4% year on year. Moving to the positives, firstly, AWS continues its strong year-on-year growth as it remained the fastest growing segment for Amazon at 37%, reaching $20.5 billion. AWS also generated the operating income of $5.4 billion, which makes it the sole contributor for the overall operating income for the company in the quarter. Secondly, Amazon's advertising business is actually bucks the industry trends, with its revenue growing at 25% year-on-year to $9.5 billion. And this is in contrast with the other tech giants, this as mentioned before, like Meta and Alphabet, whose advertising business got hurt because of the decrease in digital ad spending. Amazon believes that its strong performance was because of its unique model, where it operates at a point where consumers are ready to spend, making its advertisement more effective and thus more attractive to sellers. For the negatives, however, Amazon guided for the fourth quarter revenue to be below our forecast. The company expected to earn between $140 to $148 billion in revenue, and this is mainly because the company saw a moderating growth across all of its businesses towards the end of the third quarter. FX is expected to continue to be a major headwind, and AWS growth is actually expected to decelerate to the mid-20% range. For the outlook, Amazon guided for a full year 2022 capex of around $60 billion, and they specifically indicated that this will represent a $10 billion year-on-year reduction in its investment on fulfillment and transportation, but it is offset by the $10 billion increase in its investment in AWS. So this actually indicates that AWS is currently it's Amazon's priority, as it is looking to invest to meet the potentially high demand in the long term. As mentioned before, fourth quarter revenue is expected to grow between 2 to 8% year-on-year, with an operating income of $0 to $4 billion. In terms of our valuation, we cut our full year 2022 revenue by 3.5% and operating margin from 5% to 3.2%. And this is because we are taking into account the reduced AWS customer spending for the quarter, as well as the expected FX headwinds. We maintain our neutral rating on Amazon with a reduced target price of $108.44, with a WACC of 6.4% and a terminal growth rate of 5%. With that, I'll hand over my time to Glenn to run through UOB.
Thanks, Max. So for UOB, this is their third quarter 22 results, and we titled it Surge in Net Interest Margins. Next slide, please. So for their recent results, their earnings of $1.403 billion were in line with our estimates, mainly due to higher net interest margins as well as a healthy net interest income growth. The 9-month 22 PATMI is at 72% of our full year 22 forecast. So some key highlights: the net interest income was up 39% year-on-year from a net interest margin increase of 40 basis points to 1.95%, and loans growth of 6% year-on-year. The fee income fell 10% year-on-year, while other non-interest income was up 58%. The management is guiding for mid-single-digit loans growth with higher NIMs, stable cost-to-income ratio, and stable credit costs. UOB has also guided for the NIMs to continue to expand each quarter and to reach an exit NIM of 2.5 to 3% by the end of 2022. We estimate that the fourth quarter net interest income to jump 65% year-on-year. Management is also guiding for ROE of 13% in FY23 and 14% for FY24 from this year's 11%. Now moving on to the positives. The first positive was that the net interest income grew 39%, which was led by continued loans growth of 6%, while the NIM surged 40 basis points year-on-year to 1.95%. Just for some comparisons, the first quarter it increased 2 basis points, the second quarter it increased by 9 basis points, and the third quarter it went up by 28 basis points. It is quarter on quarter. So the loans growth quarter on quarter was mainly from term and trade loans, while the year-on-year loans growth was broad-based across Singapore, Greater China, and the Western world as business regained momentum. UOB has maintained its guidance of a mid-single-digit loans growth for the full year 22. The second positive is that the other non-interest income increased 58% year-on-year, and this was largely due to the higher customer-related treasury income. And a similar quarter-on-quarter increase was due to the record high customer-related treasury income, as well as improved performance from the trading and liquidity management activities amid market volatility. The third positive would be that the total allowances fell by 12% year-on-year to 135 million, resulting in credit costs improving by 3 basis points to 17 basis points. And this was mainly due to specific allowances decreasing by 18% to 127 million. The total general allowance for loans, including the RLARs, were prudently maintained at 0.9% of performing loans. And UOB has also lowered its credit cost guidance to 20 basis points, which from 25 basis points. The last positive was that the new NPA formation fell by 15% year-on-year and 68% quarter-on-quarter to 214 million as asset quality stabilized during the quarter. Resultantly, the NPL ratio fell by 0.2% quarter-on-quarter to 1.5%. The asset quality remained resilient, with the specific provisions ratio stable at 33%. The third quarter NPA coverage is at 98% and unsecured NPA coverage at 207%. Now for the negatives, the first negative was that the fee income continued to decline and fell by 10%, and this was largely due to lower wealth and fund management fees. It declined 8% quarter-on-quarter as well, mainly due to loan-related fees moderating from the previous quarter's high, while the wealth management fees remain soft amid the subdued market sentiment. However, loan-related fees continue to show stable growth of 5% year-on-year, and this was spurred by trade and investment growth, while credit card fees were higher 6% year-on-year as the customer spending rebounded with borders reopening. The second negative was that their current account, savings account, CASA ratio fell 6% year-on-year to 49.8%. And this was mainly due to the high interest rate environment and a move towards the fixed deposits. Nonetheless, their total customer deposits increased 6% year-on-year to 375 billion. So management has mentioned that the reason for this is that because they are concentrating on increasing FD campaigns, and that the increase in their FDs was higher than the drop in CASA, hence the increase in the total customer deposits. For the outlook, UOB's profit should continue to grow in 2022 on the back of stabilizing margins, stronger fees, and lower provisions. And we expect the full year 22 net interest income to expand 34% year-on-year. We also expect the credit cost to come in below the guidance of 20 basis points. For the NIMs, the management expects further improvement in NIMs in the later part of 2022, and they are expecting NIMs to sustain the growth each quarter and to exit FY22 with a NIM of 2.5 to 3%. For the loans growth, management expects to see strong demand for loans as cross-border activities pick up, and the ASEAN loans growth is expected to be higher with some slowdown in Singapore and North Asia. The growth so far has been skewed towards the developed markets as the ASEAN economy remains muted, but the management expects this to change as the economy recovers. As such, we maintain our buy recommendation with an unchanged target price of $35.70. However, we raised the full year 22 earnings by 6% as we increased the net interest income estimates. We also have raised the FY23 earnings by 12% as we increased the net interest income estimates for FY23 as well. And our ROE estimate for FY23 has now been raised from 11.5% to 12.7%. So that's what I have for UOB. I'll now move on to IFAST. So IFAST recently released their results, and this is just a brief highlight on their results, just to note that this is non-rated. So for their key highlights, the third quarter assets under administration, or AUA, it fell by 7.6% year-on-year to 16.98 billion. And this was mainly due to a decline in most equity and bond markets, as well as their exit from the India business. So however, their net inflows of client assets was positive at 1.86 billion for the 9 months 22. And their third quarter revenue was also down 1.3% year-on-year, and their net profit was down 72.6% to 2.09 million. However, this is they managed to go back to profitability in this quarter, as the last quarter they made a loss. So their recurring net revenue was up 5.9% year-on-year, while their non-recurring net revenue was down 38.5% year-on-year. Their interim dividend remains stable at 1.3 cents for the third quarter. So for their Hong Kong e-pension business targets, they have mentioned that there was a bit of a change, and they have said that it would start contributing earlier than guided. So it will now be contributing from the third quarter 2023 onwards. Previous guidance was fourth quarter 23. And however, they did not provide much details in their figures, and only said that the guidance will be provided in early 2023. For the IFAST Global Bank, which is their recently acquired bank in UK, it contributed 2.22 million Sing dollars to their third quarter 22 net revenue. However, they have mentioned that it is still incurring their initial startup losses, but they do target to achieve profitability starting in 2024. So that's all I have. I'll now hand it over to Terence.
Thanks, Glenn, and good morning, everyone. Keppel Corporation announced a revised agreement that will provide greater deal certainty on its transaction with Sembcorp Marine and also its asset co transaction. In our next slide, Keppel has entered into revised agreements in connection with the proposed offshore and marine transactions. So some of the key changes are that there will no longer be a combined entity. The exchange ratio has also been revised between KOM and Sembcorp Marine to 54:46 from 56:44 previously, in favor of Sembcorp Marine. So what that means in summary is that Sembcorp Marine shareholders will, under these new and improved terms, receive need to pay out less to KOM and also need to disburse out lesser shares to acquire KOM. The retained stake by Keppel is also revised to 5% from 10%. So just to recap what this thing is, previously they proposed to hold 10% of the stake, just to ensure that if there's any contingency, they still have this 10% there to pay off. But I think with most of the agreement, most of the approvals now obtained, they realize they don't need to hold such a big stake. So now it's revised down to 5%. What that means in total is that Keppel shareholders will receive an estimated 19.1 Sem Marine shares per Keppel share held, with an implied value of $2.33. This is higher than the earlier indicated amount of 18.5 Sem Marine shares. And our projected value of Keppel Corporation x the O&M business, after what this means here is after you strip out the O&M segment, is valued at about $6.62. So we appreciate that this one can be a bit confusing, but what it means is that for every 1,000 shares of Keppel, you will get 19,100 Sem Marine shares. So you can just multiply. Separately, the asset co transaction will also proceed independently from the outcome of the KOM and Sem Marine transaction. So if you look at this table here on your left hand side, you can see that the KOM consideration, this is row number 3, is now reduced from previously 4.874 million to 4,495 million. So this is a reduction of $378 million in KOM consideration. The shares to be issued to acquire KOM has also been reduced by about 3 million shares. In terms of the positives, in our next slide, the decoupling of the asset co transaction provides greater certainty on the outcome of its stranded rigs, because they don't have to depend on how Sem Marine shareholders vote. The decoupling of the asset co will proceed regardless of how Sem Marine shareholders vote. Secondly, there's also better certainty of deal completion. The now revised terms offers is a sweetener to Sam Marine shareholders essentially, because they're giving more, they're lowering the upfront consideration, which means the dilution upfront is less, and there's more. Sam Marine shareholders also benefit from the improved merger terms and also a higher order book from the acquisition of Keppel O&M. Separately, Keppel is also on track to exceed $5 billion of asset divestment by 2023 based on management's guidance. But we think that they will hit their target by first quarter of 2023, because assuming the deal proceed, it means Sam Marine shareholders and Keppel shareholders vote for the acquisition to take place, then they will just cross the $5 billion by first quarter of 2023 already. In their third quarter results announcement, the energy environment was also ahead. This was driven by higher recognition from its Hong Kong integrated waste management facility. What the negative though was that the urban development continued to drag because of the outlook in China. The property segment continues to be a laggard, but the outlook has improved according to management. In terms of the outlook for Keppel Corp in our next slide, the divestment of KOM will further transition the group towards an asset-light structure. With the asset co transaction delinked, management disclosed that it continues to receive active inquiries for its legacy rigs on the back of a more favorable operating environment. The OpCo, which is Keppel O&M, excluding its legacy rigs and receivables, is also expected to be profitable in FY22. So on the back of this, we maintain our buy recommendation on Keppel Corp with a sum of the parts target price of $8.95. This is still based on a 20% holdco discount as Keppel moves towards being transforming its business to being more asset-light. So that's all for me for Keppel. I'll now hand over the time to Zain.
Thanks, Terence. So I will now talk about the technical analysis section. So for Straits Times Index, we're currently in a 5-wave downtrend. Last week looks like we reached a temporary bottom at the wave 3. So for this week, rise, the immediate support likely is to be at 2,970 to 3,040 zone. Last week, we also had registered a bullish crossover on the MACD indicator on Friday. So likely we see a bounce this week on the wave 4. We probably reach the immediate resistance at 3,070 to 3,170 area, where the 38.2% and 50% Fibonacci retracement level from the wave 2 high to the wave 3 low might act as some resistance for STI. For S&P 500, we broke out of a downtrend channel. Currently, we are in a trend channel for now. So currently, the immediate support is likely to be at 3,730 to 3,800 zone, which was a previous resistance area formed by the island formation at the start of October. For resistance-wise, likely we see it at above the 50% Fibonacci level, which is 3,900 to 4,150 area. So 3,900 is around the 50% level, and 4,150 is closer to the 78.6% level, and also it meets the downtrend channel resistance for S&P this year. For individual stocks wise, there's Land Escort Trust. So for this, we have a technical buy at 91 cents, the take profit level at 99.5 cents. Stop loss can be placed at 88 cents. The stock last closed at 94 cents on Friday. So for Escort, we see a potential bounce to retest the resistance zone at around 96 cents to 99.5 cents in the current downtrend. So the price actually formed a bullish reversal Morningstar pattern on the 26th October at the support area of 87 cents to 89 cents, which is confluent with the swing low of 87.5 cents made in early October last year. The MACD indicator also showed a bullish crossover, where it means that there's actually bullish momentum coming in the current downtrend. So with that, the price could reach the resistance level at 99.5 cents, which is where it meets the downtrend line resistance, and also a 50% Fibonacci retracement when we use a swing low of 87 cents and a swing high of $1.17. From an elliott wave perspective, the wave 3 also reached about 200% extension from the wave 1, and thus we could see a retracement to the resistance zone to form the wave 4 in the current downtrend. So that's all from me. I'll pass on my time to Paul to talk about Sheng Siong, the quarter results.
Thanks, Dean. So I'll move on to Sheng Siong's results, which was released on Friday. It was a tough comparison, but better than expected sales. Next slide. So for Sheng Siong, the results beat expectations, although you can see that the earnings was down 4-5%. One of the reasons is some of the positives from the results was the still healthy margins. So they continue to raise the contribution of sales from fresh food, which is the highest profit margin. So fresh food referring to meat, seafood, and produce. And one of the strengths compared to some of the peers that you see outside the grocery industry is the ability to manage their fresh food. So one of the things that help them get more competitive prices is also they directly source and also the processing of the meat and seafood in the stores itself. So all this needs a bit of skill sets, and that's the edge over their peers. The other positive was the store rollout was normalizing. So if you recall, in 2021, there was virtually no new stores because of the shutdown in the opening of new stores by HDB. So this quarter they added one store, and net if you look year on year, there's at least a 5.5 percentage points growth in square feet. So this is important because this will help at least provide the headwind in FY23 next year in terms of growth. So new stores actually contribute to growth. That's one of the main growth stories for Sheng Siong. So they are still on track to roll out 3 to 5 new stores per year over the next 5 years. They have right now, I think 60 plus stores, and they mentioned the competitors have 200. So there is room. It doesn't mean you go immediately to 200, but there is still a long road runway for them to expand new stores. The negative is big same-store sales growth. So big same stores means those stores that is older than 2 years. So that is still down, and one of the reasons is because last year the sales was exceptionally robust because there was a closure by the Jurong Fishery Port and the Pasir Panjang Wholesale Centre. So last year, because of those closures, a lot of consumers shifted to Sheng Siong to buy fresh products, meat and especially seafood and so forth. So the same-store sales was down 7%, and this is higher than the 5% decline in second quarter. So in terms of the outlook, we still do expect weakness in revenue for Sheng Siong until the first half, mainly because of the whole reopening of borders and also relaxation of measures. So as a result of this border control return to office, we should expect home dining to decline, and this will affect grocery sales across the industry. So our expectations is for growth to resume second half 23, especially when they expand more stores. So we still maintain a buy. I think we actually raised our earnings for this year because of the better than expected results. And one of the strengths of this company is their attractive ROE, the dividend yield, and of course their net cash balance sheet of 200 plus million. Next slide. Next slide. So in terms of some of the macro news, the first one will be industrial production. I think the key takeaway is that manufacturing activity is slowing down, especially electronics manufacturing. So we saw, I think this is the second month of decline for electronics, down 7% in Singapore. Some of the hotspots in Singapore is, of course, hospitality. So RevPAR, which is hotel revenue, hotel occupancy times room rate, is at all-time high. So for September, the RevPAR is up 135% to 237. Of course, the F1 also had some favorable impact. But if you compare to pre-pandemic, it is about still 15% above pre-pandemic. So the hospitality has recovered very strongly, despite not having any Chinese visitors. The other news was residential market. So for the residential market, the volume is down 22%. So this won't be good for the real estate agents. Volume is across. So this volume refers to new home sales, which is down 38, resale, private resale down 31, and even HDB also was surprisingly down 11. But prices remain very robust. So property prices is up 3.8% quarter on quarter. But if you look on a 12-month basis, that means year on year, it is up 13.6%. This is the fastest rate of growth. The last time we had such a strong growth was in 2011, and this was when the last time the property market was exceptionally hot, and before they introduced TDSR in 2013. So the growth rate is still very strong, and one of the reasons is just the lack of inventory. So inventory actually still dipped to 15.6 thousand units. So based on the last 12 months property sales, the amount of inventory is 1.7 years compared to on long-term average about close to 3 years. So our inventory is about 15,000. So you can roughly take maybe 9 to 10,000 homes sold per year in terms of private homes. You can see the inventory is quite thin. There's only 1.5 years. The other news that came out in the big news in the US is also the inflation number, which is the so-called the Federal Reserve's favorite gauge of inflation. They always target 2%. It's still rising 5.1. So mathematically, to hit their 2% even within a 12-month visibility, you need month-on-month to drop to at least slow to 0.2%. But the problem is month-on-month is still growing. So month-on-month inflation is still rising. So until we see some 0.2 or even 0.3, then at least that gives some hope that the core PCE can slow down and come. At least there's some visibility that it will hit their 2% run rate, the 2% target. So technically, what we see is that the banking sector is taking the lead. So we see that there's leadership in the US equity market is shifting from technology stocks to finance, and to a certain extent, even industrial stocks are doing much better than tech sector. We also see, of course, Singapore. So for Singapore, our view is that the big growth that we've seen for UOB is only starting from this year, because the margin expansion is only mainly starting this year. Because first quarter, I think for UOB was only like 9 basis points. Sorry, it was only 2 or 3 basis points, then 9. Then this quarter is almost 30 basis points. So we still got a lot more. We think there's at least another 4 more quarters of strong earnings growth for the banks from just higher net interest margins. Because 40% year-on-year growth for net interest income is a huge number. The other team that we think will also do well in Singapore is the reopening team. So like we mentioned earlier, hotel is now 15% above pre-pandemic. So even the casinos like Marina Bay Sands, their mass casino takings, I mean, this is the mass market, is also 4% above pandemic. Above pre-pandemic. Above pre-pandemic levels, above 2019 levels. So the other thing to take note is, of course, the big meeting that we were having tomorrow and on Tuesday, the FOMC meeting. So the thing to watch, I guess, we think is also any signs that he might make a smaller rate hike in December. So the market might try to front run this, saying that the Fed might pivot, because the whole market is just trying to front run the Fed pivoting, which is basically the Fed will slow down interest rate hike. So, but the market might take it. I mean, I guess those who are extremely bullish will take it that slowing down will be a sign of them eventually stopping, which we don't think so. But anyway, that could be something to watch. Will be how they guide the December rate hikes. Although they'll probably say it's data dependent, but any signs that they might slow down, then the market could move. In terms of some of the webinars we have, the upcoming ones will be Keppel REIT and Elite Commercial REIT. Next slide. So this is just an illustration of the surge in RevPAR. So the RevPAR in Singapore, revenue per available room, what it means is that you take the room rates, which is at record levels, times occupancy. So it's like revenue that we mentioned before for hotels. So it's a record high at 237. The chart on the right is just the Marina Bay Sands. The blue line is the mass market revenue. That means how much they make from those people who play cards or even do on jackpot machines. So that's the blue line. So it's above pre-pandemic. The red line, the red bar you see is a rolling chips. So this is a VIP. So you look at it, so it's on the right hand side actually. So about 7 billion chips was exchanged. So you consider it as, this is not the takings, this is not the revenue they make, because there's a win percentage of maybe 3.5, 3.7, but this is the amount of chips, the VIPs that go to casinos and they change. So about 7 billion during the quarter. But you can see the big recovery that's underway even in the casinos in the third quarter. Next slide. Okay, so what we mean by leadership is, if you look at this is the performance of the US equity stocks by sectors. So you can see that when the pandemic happened in March 2020, the Nasdaq was the one, the red line on the left is the one that took the lead, that led the market, because this is the strongest sector. But since December 20, you can see the Nasdaq, of course, has dropped a lot. What has holding back or taking the lead or outperforming is the finance industry. To a certain extent, also industrials are like those old industrials. So tech is losing its lead and then being replaced by finance and also industrial. Next slide. So this is just an illustration of the Singapore property market. I won't go through. The blue line is the property price index. Then the one on the right is just to show you the inventory. I didn't run through that. Next slide. Just a very quick one. So this is the Suntec Phillip on the ground. We don't cover, but just to give you some key highlights. So their DPU, if you look on third quarter 20, you can see that the DPU was down. You look on the chart here, down 6.6%. I guess the focus for the whole market, at least in the analyst briefing, was mainly on their gearing. So because their ICR, which is the interest coverage ratio, because MES has a rule that if your interest coverage ratio is 2.5, then your gearing ratio is capped at 45. So but what it means is that if your EBITDA, that means your income, if your EBITDA can only cover interest by 2.5 times, then you then you're very highly geared. So they want to cut your gearing, this MES rule. So, but you can see that Suntec's gearing is 43%. So I think a lot of discussions is about this gearing. So they said they hasn't exceeded, but you can see that it's extremely tight. Because they can, if that means that there's no room, there's only like 2%. So there could be a risk that they need to raise money. So some possibilities include no rights issue or even disposing of some Suntec office, which is in the book about 2000, 2003, whereas the recent sale, I think we saw on the news, is about almost 3000. The other thing was just on the China reopening, since they monitor, they just say that after the politics, the authorities should be focusing on the economy, and then China needs economic growth to sustain the people, so they cannot close it up for too long. But, okay. Yeah, I think I won't run through this since it's not written anyway, but just for everyone's reference. If you have any questions? Okay, I think this is the last one. You can move on to Q&A.
Okay, let me turn on my camera. Yeah, so I'll take one of the questions. I think it's regarding UOB. It asks, regarding the target price for UOB, as you have raised the earnings forecast for FY22 and FY23, but the target price remains unchanged. Can you share what has gone negative in your target price derivation? So our target price is based on the FY20, full year 22. So we raised earnings for full year 22 as well, but we have lowered our fee income and increased expenses. So this is following the guidance of UOB, so what they expect. So we have changed that. That's why our target price has remained unchanged. So nothing has gone negative per se. Okay, I'll hand it over to the rest of my colleagues first.
Yeah, thanks, Glenn. I'll take one of the questions. It's regarding Apple, because the question is since we have cut all the TP for all the big techs, can we share our view on TP for Apple, or is the current target price of $198 is maintained? So yeah, for Apple, we are actually in the process of reviewing it at the moment. So do keep a lookout on the reports of target price and outlook for the stock. So yeah, it should be released in the next few days.
Hey, let me take one question. Since here, Jonathan, is Meta game over? Looks like Zuckerberg is all in on Metaverse and it's make or break. Yeah, so I guess first of all, you look at that the Metaverse and reality labs in general is a very long term. Definitely, like 5 to 10 year kind of out. So as it's still losing money right now, which is expected, we just think that given the slowdown in digital advertising, the timing of continuing to spend the kind of money that they're spending on reality labs is just a little bit, I guess, it's just a bit concerning at this point. But that being said, once digital advertising starts to bounce back, and it should eventually, given that long-term tailwinds are still intact, then people will probably start to focus more on that instead of what Meta is actually doing in terms of metaverse spending. But there are some. So on the call, Zuckerberg is actually quite optimistic about the metaverse. Obviously, there are certain areas where it could be improved, and obviously a lot of areas that are still on track. But we do also think that it's still in its very early days to actually make any sort of make it or break it kind of conversations, given that most of its revenue, like 90+% of its revenue, still comes from digital advertising. Yeah, so it would be a make it or break it if digital advertising starts to come to a halt and starts contracting. Then it would really be very concerning. I also saw a couple more questions on yeah, please comment on Netflix going forward. Yeah, so for Netflix, we're actually quite optimistic about it, especially given the fact that it started gaining, net membership additions again after 2 quarters of losses due to a big part of it was due to the Russia-Ukraine conflict. We think that the addition of a new ad-supported plan is definitely going to help margins moving forward, which is a good thing. The company also expects this supported plan to have about 500,000 users by the end of this year. So that's quite lofty goals. There is obviously the concern that this plan would in essence cannibalize some of the users from its other like basic and standard plans. But I think just mainly because a lot of the revenue that's generated from this plan, it comes from your higher margin ad revenue. We do think that it would still be quite benign for at least the first half of next year. Maybe we'll only see a significant impact towards the tail end of next year. But definitely in terms of streaming, Netflix is well positioned to capture and continue being the leader in on-demand streaming. Yeah, I think that's all for me for right now. I hand my time back to my colleagues. Thank you.
Yeah, I think the rest of the questions is the queue. Terence, appreciate update on Sembcorp Marine, reference to its merger status with KOM. Thank you. Yeah, so the Keppel, Sembcorp Marine and Keppel O&M or Com, they really enter into this revised agreement. Under this revised agreement, the timeline for completion is expected to be faster now because they don't have to go to the court and get another court order from them, which will take a longer time. They estimate that under the previous process, you have taken 2 months longer. So under this new arrangement, the whole deal can proceed much faster. They are guiding for a timeline of 4th quarter or 1st quarter of 2023. So in about 2 months' time, the whole deal can actually be completed based on the assumption that the shareholders vote for the deal, of course. Terence, Trust has resigned. Previously, you mentioned price cap imposed has subdued impact on SCI. Is there any change to this now? Suntec is Prime Minister. So no change to this. We talked about our price cap on the market. It was a very costly step because the government is essentially capping the price, right, that the consumers have to pay for electricity. But even then, we also didn't believe that the impact on Sembcorp Industries would be significant. That's why we say subdued impact. And now with the new PM, there hasn't been any update or changes to the existing position. So we don't expect this to have any impact on Sembcorp Industries. Same with our previous view. Also, Sembcorp Industries announcement, hydrogen deals with Japan and Indonesia recently. Will there be update reports on them? We will have an update report on Sembcorp Industries to talk about their more recent developments, more the results. Also, they haven't released their results. We expect it somewhere in maybe the mid of November. But we won't do any update on the hydrogen deal. Because it's not a hydrogen deal, right? It's more they're just exploring feasibility studies with with hydrogen as for energy. So there isn't anything substantive. They haven't signed anything. There isn't anything that's going to come out of it for this hydrogen. It's a feasibility study at best. Yeah. Next question. What is the outlook for sets, please? So in terms of the near-term outlook, the sets will see higher costs in the near term because they front-loaded a lot of the growth in the near term. So a lot of these manpower costs will eat into their margin in the near term, and until they can achieve operational peak capacity, is now about 75% capacity, then they won't be able to take advantage of the operating leverage associated with their business, because it's a very heavy fixed cost model. With some parts that are variable, of course, because of the huge fixed cost component, the under capacity from what is used to produce is weighing on their results. But having said that, the main drawback of their share price now is they need to get the funding of their acquisition of the Worldwide Flight Services, WFS, sorted out. Once they get that sorted out and there's clarity on how much they are going to issue, then I think we'll see re-rating. But until they sort out the funding structure, we think that the outlook for stats, at least in the near term, would be subdued. I think that's probably all the questions from me now. I'll hand back to the rest of my team.
Yeah, so there are a couple of questions on these. First one is, how much of the Scott's foreign currency distribution is hedged? So for them, about 50% of their income that they receive is hedged in foreign currency. And in the first 9 months of 22, because you see that the foreign currency really affected like the wide swings in like the pound, etc. And also because of that wide swings, they were affected 2.1% of the top line. For the 9 months 22. Because they are 50% hedged, if not, they'll be affected more. Yeah, then for the next question, there are some retail REITs such as CICT and CT have reported decent sets of results. Will there be initiation reports on them? So for the initiation reports, we'll probably look at a time when we think it's a good time to initiate on them with a buy rating, because you don't want to initiate and then it's not a positive outlook for us. So yeah, we'll be looking into that. And then what do you expect from SCT results? So SCT actually, they reported their results last week. Yeah, the target price and everything is under review, so it will be out by next week, Monday webinar. So I will update that on next week. Another question is if Darren or Paul, with current global economic situation and geopolitical tension. They give our latest view on S-REIT and whether it's still a safe form of investment should we stay out. Yeah, so for me, I think this upcoming Fed meeting will be key. Like we see that J-Powell or the Fed, they decide to pivot, as Paul mentioned earlier, then there might be a sharp rebound in S-REITs. So yeah, that what they say this week will be very, very important, like on the interest rates and such. Yeah, I think that's all for me for now on. Can you comment on Land District? Land District, they will have their earnings next Monday. So yeah, I can update you on that after that. Yeah, okay, I'll hand on to the rest of my teammates for now.
Yeah, thanks, Darren. I think I saw a few more questions pop up for me, so I'll just take them first. So UOB, one of the questions is UOB recently acquired some Citibank regional clients. What is the impact? So they said that it's not, they haven't given any figures yet, and I think only 2 of them will be going live this tomorrow actually. Yeah, so the rest will be next year. So however, the impact would be that they are expecting a higher ROE of more than 13% and a ROA of around 2% by 2026 with this acquisition. But this is quite some time back. But this was when they had the acquisition and they had a call for this. So now they're already targeting of a high ROE of 13% next year already. So I think they haven't given much details yet. We probably have to look out for the next call where we can ask more details. Another one was, what's your take on CapitaLand investment? So for the outlook for CapitaLand, CLI, would be that their real estate investment and lodging management businesses, they should continue to recover. And this is mainly on the back of the further easing of travel and mobility restrictions. However, the lockdowns and the tightened restrictions in China have actually impeded their business discussions, and this may delay their planned transactions if lockdown persists. So the prolonged lockdowns may delay their planned transactions. But saying this, the pickup in travel as well as the lifting of lockdowns in China would be immediate catalysts for CLI. I think there's one more, it's a 2-part question. I think I'll try to take the first part first. It says, is the Fed slowing down of Fed rate negative for the bank's earning and share price? So I would say it's not so much of a negative, but more of a less positive. So the bank's NIMs will still continue to increase. And if there's a slowdown of the Fed rate, it will just increase slightly slower than what we are seeing now. I mean, there's I think 28 basis points quarter-on-quarter increase in their NIMs. So if there's a slowdown in the Fed rate, then this might not be such a drastic increase. So sometime maybe I think they're expecting also this will continue into the year end and into the first 2 quarters of next year. So the NIM growth will be this high for at least the next few quarters. But moving forward, when it starts to the Fed rate, the hikes start to taper off, then we might not see such a big increase. But their net interest income will be already at that level and it'll be very high and contributing to their PATMI. The second part, I think I'll leave it to Paul for that question. I think there's one more for me. Okay, there's actually 2 more, sorry. So would you expect the US banks, JP Morgan and BOA to perform positively in the next year? So the main difference between the US banks and local banks is that they have this, I think their investment banking arm took quite a big hit. And they also have reversed they have gone back to pre-pandemic levels of provisions. So they reversed their provisions very aggressively last year. And now, it looks bad because, they are going back to normal provisioning level. So that's the reason why their bottom line is not as impressive. But if you see their net interest income, it has also been growing at double-digit figures. So if we move into next year, where everything is more of a normal level for their provisioning level and their investment banking arm sort of recovers, then yes, it might perform positively. However, we don't cover the US banks, so it's just my personal opinion. Okay, one more. The share price of the 3 local banks have run up for the past few days. Is the trend sustainable? If you look at what they are guiding, I think it's sustainable at least for the next for quite some time. I mean, they have also mentioned that the region that we are in, the ASEAN region, it's quite protected from the rate hikes. So during the UOB, only UOB has come out with their results. So they are actually benefiting quite a lot from the interest rates hikes, and their NIMs, it should be quite similar across all 3 banks. I mean, they should be showing double-digit basis points increase in their NIMs. And that's why I think they are expecting the same for the other 2 local banks, which is why the share price has gone up. I think I'll hand it over to the rest of my colleagues first. Thanks.
Yeah, thanks. Let me just try to answer some of this. Your views on Propnex and the dividend, will it remain constant? So the earnings will be, of course, very big. We've already factored that in. So in terms of what dividends Propnex can pay, so their number of shares that Propnex has is about 370. So you assume like they have 400 million shares. So my forecast is about 9 cents. So they can 9 cents, right? So which is the yield now maybe 6% plus. If you assume 9 cents dividend or 10 cents, that means they are paying just roughly the ballpark number about 40 million in dividends. They can manage this because that's the amount of cash they generate a year, and they also have another 140 million of net cash in the balance sheet. So, and they've always kind of mentioned they want to pay attractive dividends. So that's one of the thing, because they want to make this stock attractive. So we think the 9 cents dividend is sustainable. Not only because there's cash flow and there's enough cash in the balance sheet, it's also because the management intends to do so, or at least they have intention to keep it as a attractive dividend paying stock. The other thing is Netlink or StarHub or HRNet better for dividend against inflation? Netlink definitely not, because Netlink, the dividends is about, I think 5% yield now, I think, but they won't grow. There's hardly any growth. And they're going to do a revision of the rates, which we think might come off a little bit, but at the same time, they can also have lower. They can still manage to maintain the dividends. So for me, Netlink is not a hedge against inflation. The reason why I hesitate is because sometimes the way they calculate is a bit complicated, but to determine the next rate hike, to determine how much tariffs they charge us, right? I mean, we are the users of fiber, also depends on interest rates and so forth. So it's not very clear, but right now, the next, at least the next revision, we don't think so. That's why we are always worried, because the interest that the dividend they pay is going to be quite fixed. Yeah. About, I think right now maybe 5% plus in terms of dividend. So for StarHub, it's a bit better if they can raise tariffs. The reason why we hesitate whether are they a hedge against inflation is always because of competition. You may want to raise you may want to increase prices, but can competition allow it? So it's not we cannot directly translate it, but at least cyclically we think StarHub can raise prices because there's a roaming revenue. But the reason why we hesitate is not very clear cut whether these companies is a hedge against inflation, as your question. It's because of competition. Because I mean, we never know how competition will react. But telcos are not so bad because they've really been consolidating so much. So even in Singapore, we have 4 operators now. I mean, I won't be surprised if we drop to 3. I'm not sure about 2, but at least we definitely could drop to 3 or even who knows, maybe even 2 operators. So that would be the better way to get price increases than the direct hedge on inflation. For HRNet, it's a bit clearer a little bit because they charge their clients based on the salary that they place out. So it's usually 25% of the annual salary. So, and if the salary of the candidate goes up, then they can pay more. Likewise, the margin they charge for flexible staffing is also dependent on salary, right? Because the margin is on top of the salary. So for HRNet, a bit more comfortable to say that their dividend is a hedge against the inflation. It's a bit clearer, yeah. Of course, again, competition is always out there, but at least we get that direct translation, the direct impact. Because of higher wages, they can charge more. Update on Bowstate. Yeah, sorry, we don't cover, don't really have much briefing on it. Yeah, so sorry for Bowstate, we're not very familiar. Yeah. Paul, with SG Treasury bills likely to hit in the 5 to 5.5% range towards second quarter, your views on investing on REITs or equities? Yeah, we think REITs, I think, will become much more attractive because it depends which REIT has priced in all these hikes. So we think, like we highlighted before, some of the local REITs haven't, even though some might be trading at 4-5%. But like you said, if interest rates go to like we said, the new hurdle rate is at least minimum 4%. So anything you buy now need to at least pay a 4% because that's the risk-free rate now. It's a bit of a change from 0 to 4, right? So it's a bit of a sticker shock, but 4% should be your new hurdle rate for in general anything, because everything is going to 4%. So we think some of the foreign REITs, like the US ones, like Prime or that, has begun to price in. They're trading at 11-12%. But again, it's just the timing, and then you come in early is also considered wrong. So for us, we always have to be like time it perfectly. Of course, we can't. We never get it right anyway. So never get the timing right. But for us, we think maybe next year the REITs should be a good sector because we just want to be paid for all these higher interest rates for REITs. One way to try to understand it a bit more is that if a REIT was a corporate bond now, if you look at the corporate bonds, let's say you own a corporate bond, you want the spread to widen now, right? Because let's say if risk-free rate or government paying 4%, I want at least a wider spread, 2 or 3% higher compared to last time, because if a corporate bond, the credit risk is higher. So if you use the same analogy for REITs, right? With interest rate rising, there's higher risk, and so I need to be paid more. But the problem is that I think when we did our third quarter, you can see that the spread actually shrunk. So it doesn't make sense. I'm not being paid. So the spread, we want the spread to widen a bit more. Spread means that if your REIT is paying 7%, that means the spread is 3% over the risk-free rate of 4%. So we just want it a bit wider before we think it's worth buying it. But I'm getting paid for all these higher interest rate risks, which we think the US REITs have already done so, like some of these like Prime. But again, with the Fed raising at least another 150 or more in interest rates, we just a bit more. We just want to time it a bit more better, I guess. Maybe early next year. Yeah. Hopefully, we're not too slow by me. Yeah. Hi, Paul. Is the Fed slowing down or Fed rate negative for the bank's earnings and share price? Would that result in REITs and tech starting to run up going forward? It might. But it might be. They might actually only slow down. I think that's the whole debate now. That you want to be ahead, like you want to front run the Fed, right? You want to front run when the Fed slow down, then the market move. But we just think that the market always gets it wrong in terms of thinking that the Fed will pivot. So we think it's probably more of end of first quarter, early second quarter result. So even for tech stocks, is as mentioned by the team, the growth, even if you're buying now, the growth rate isn't that great because you still have this recession or very sharp slowdown ahead the next 12 months. So, but for the banks, what we think is that we've got at least 4 quarters of earnings momentum, and then it will stay there. It doesn't mean it will drop. That means the NIM will continue to climb, but it doesn't mean the NIM is going to drop after that. It will just stabilize. I think that's what even the banks are guiding. It might probably peak in second quarter 23, then stay there. It doesn't mean it's just going to collapse because interest rates is a new paradigm now. It's not going to drop because inflation is so high. So what we think is that interest rates will just go up and stay up, and then the banks would pay good dividend this year and also pay very good dividend next year. Then after that, maybe end of 23, then maybe I think maybe go back to other sectors. But like what you say is correct. I think REITs is an easier one. Tech stocks is a bit tougher because you still need earnings growth. But REITs is a bit easier because if the Fed hold, right, then there's not much risk for REITs, the compression in the interest rate. Sorry, it might be a bit confusing to everyone. But again, we just want those that are paying, like the US REITs are paying like 10-12% and then trading at 30% discount to book. I think those really kind of price in a lot of the interest rate risk. And then you get, I mean, on paper, hopefully you get, of course, a very attractive 12% or 11-12% dividend yield. And you're just hoping that the market don't deviate and the market might collapse the discount to book value. And then get maybe, I don't know, 10-15% 10-15% close capital gain by closing the discount. Again, this is all theory, but I mean that's one possible scenario. Okay, I answered this last time before I'll turn it over to you, Zain. Paul, in your previous week, your year-end STI target was 3.5. Don't you think it's a bit too? Yeah. So our 3.5 really depend on the banks. Yeah. So if the banks, we think there's still upside in the banks. So that is the thing that's anchoring the STI. Yeah. And of course, the anomaly here is our target is always a rolling 12 months for what it's worth. Yeah. Okay, Zain, hand it over to you. Yeah, can you help out on some of this? Some people are asking your time frame for daily chart and candle weekly. I think better that to get it out of the way. Yeah.
Thanks, Paul. So, okay, first, I think I will just go through the time frame question. So, the question is, let's see, for investment time frames for daily candle, weekly versus monthly. So, I think if you are looking at daily candles wise, for example, okay, let's see this one example CICT. Then I think your time frame is probably maybe like quite short. Maybe the shortest probably might be 1 week, and to maybe like 1 month or 2 months, 3 months. Because like for if you're looking at daily time frames wise, what you'll be tracking is probably the faster moving averages like the 5, 10, 20. If you're looking at the weekly time frame, I guess at least will be 3 months. So that's about 12 weekly candles to consider. Time frame we are looking at maybe it's about 30 to 50 day moving average. And for monthly wise, I think it will be the longer term time frames to make sure, because if you're looking at monthly time frame, you are just checking whether the trend is still intact, the long term trend whether it's still intact. So I think you'll be looking about at least 6 months, 1 year, around there. Moving averages to consider will be around 100-day and 200-day MAs. So that's a general guide, I think. Okay, so then I'll start off with the TA questions. So for Mapletree Pan Asia, currently we are still in this downtrend channel for now. It's still a bit weaker compared to some other REITs that have gone out of the channel. So for now, the immediate resistance likely to be near about 170 to 173, which was a previous strong support area that we broke down of this red zone. For immediate support wise, probably around the swing low that we form around here, that's 155. That also tags to this channel support over here. So maybe 155 to about 160, 163 over here might be a support, temporary support for Mapletree Pan Asia. Then for the hot stock now, which is UOB. So after the earnings, we broke out of this downtrend channel over here. So then currently was a strong 2 days. We actually broke even above the two resistance zones actually. So the first one was over here where we broke down off, face resistance over here, managed to break out Friday. Then today we broke through, we climbed above a resistance level of 27.90. So I think for now, if we go further, the next level to look at is maybe this $29 level here, which is a swing high resistance last time. So that will be a level to pay attention to. For immediate support wise, probably this zone over here. So that's about 26.70 to 26.90. Probably will hold for some immediate support for UOB. Okay, then HOPA. So for HOPA currently is still in a very strong downtrend over here. I think for that, he also broke the there was a few retests of this level here where close to 999.87 actually. So that will probably be an immediate resistance level over here for HOPA, about 990 stretching to about $10 over here. For currently the immediate support wise is around the swing low over here near $9, where we saw some bullish divergence happening over here also. So when price made a lower low, but the indicator made a higher low. So currently temporarily, probably some bounce that will take place over here. But if we reach a lower support, then last time we actually saw a level about near 870 over here. So that's a lower support for HOPA. ST Engineering. So ST Engineering, we had a bounce after we reached close to the 61.8% retracement level. That's about near 310. Then we reached about 312 and we had a little bounce over here. For now, I think the current strong resistance is actually at close to the 340 to about 350 level. So which also meets the previous support area over here that we broke down off. Then which is over here, probably some resistance over here, as well as it meets the 38.2% Fibonacci level. So that's for ST Engineering. Mapletree Logistics, we're currently out of this downtrend channel over here. However, looks like there will probably be immediate resistance lying at 156 to 161 area, which was a previous support zone over here and also support zone over here that we broke down off. So a retest probably acts as a resistance for now. Then for immediate, the resistance also meets around the 50% Fibonacci retracement level over here. As for the immediate support, probably near 145, 61.8% level, and we actually formed temporary bounce over here after we tagged to the channel support over here. So around 144, 145, you can see there's a level over here, probably will act as current support for now. Then first resources wise, I think for now there's a chance for a double bottom pattern to take place. So that we did a sort of double bounce over here. Likely the immediate resistance wise, probably at around close to 155 to 160 area over here on the immediate swing high resistance. Then immediate support will be this swing low that we bounced off around near 130 level over here. I think yeah, so that's for first resources. And okay, the other banks will be DBS. So DBS, that time it was trading inside this uptrend channel over here. Then when STI was weak, it broke over it and broke down a little, but formed a consolidation area over here, but it was still above, we are still inside this support area for TBS. Then after that we was led by UOB and continued to shot up higher. So now we actually broke out of this uptrend channel over here. So the next resistance probably near this leverage zone over here, which is around 35.10 level, which means this swing high over here. So and then if we actually go higher than that, then probably reach the year high of near 36.30 over here. So that's the immediate resistance for DBS. For immediate support wise, if it pulls back, then probably the channel support over here probably add some support near 33 to 33.30 area, I think, over here. Then for OCBC also followed suit, broke out of this downtrend channel, also above this immediate resistance of $11.90 to $12. So I think the next resistance to equate up to is maybe near 12.30 to 12.40, which was tested twice over here this year. And for immediate support, probably around this resistance zone, around 11.80 to $12 that we broke out of. So that's for OCBC. CapitaLand Invest, very weak for now, has been on a very strong downward momentum. We also broke the most recent swing low support last time at 318 to about 325, currently at 303. So I think we are quite near to the historical open price for CapitaLand Invest. So I think the next support area might be this maybe near 280 to 290 if it continues to fall. So that will be a retest of the opening price last time. For immediate resistance wise will be this on the 320 area, or 320 to maybe 330 over here. Then higher than that, probably around 340 above. Also, there's a resistance over here, which was a swing low that we broke down off. Okay, Ascendus. Okay, so Ascendus actually raised for a very long time. So then we actually broke down of the strong support at around 260, which also the 50% level. Then we tagged to around just nice the 61-point level, that's about 246, and we had a bounce up again. So for now, I think resistance wise, if you look at the Fibonacci levels, maybe the closest one around 273, which is also the swing high over here. Then if you go higher than that, maybe near 280, 61.8% level, which was a swing low over here. It could act as a resistance now. So that's for Ascendus. TJ Darren USD. Okay, so for this stock, looks like it just reached the support recently. So the very strong support zone is close to 88 cents to 93 cents level over here, where we tagged many times over here. We had a bounce from it recently. So for the resistance wise, probably I think we'll see it close to the 104 to 107 levels over here. So that's the 50 and 61.8% levels. And we also formed at time we also had a consolidation around here before the price broke down further. So we could do a retest over here that acts to the resistance. So that's for this stock. And then 392 China Aviation. So China Aviation, most recently we tagged to this swing low of the pandemic low. That's around 66 cents over here. Then we thought the stock did a little bounce over here. I would think the immediate resistance probably around 71 cents to 75 cents area over here. So which was a swing high level over here. For immediate support wise, probably will be the recent swing over here around 64 cents. But note that the stock is still in very strong downward momentum over here. If you go down further, we might actually go back to maybe close to the 50 cents region over here. Yeah, so that's for China Aviation. Okay, then Sembcorp Industries. Sembcorp, interestingly, today we broke out of this downtrend channel over here after it was a pullback. So for the immediate resistance wise, I would think it will be near the first one is 38.2%, that's around 305, which was a previous this red color zone from 3 to 305 maybe, which was a key zone last time. So that could act as short-term resistance. Go higher than that is around 314, which we saw some swing high over here. And then higher than that, around 320, 322, 323 area. So that would be a retest of this trend line that we broke down off. So an immediate support probably will be this swing low from 277 around here, which was a swing low over here. So this green color box, we came back to acted as a support for Sembcorp Industries successfully for now. Then Keppel Corp. Okay, so long term in the uptrend channel this year. Briefly, we pulled back in this downtrend channel and broke down of the uptrend over here. We kind of pulled back up over here. So let's see whether it can remain to continue in this uptrend channel. For the immediate resistance, probably this swing high around 710 over here, where we saw it was a level over here. We broke out and retest before it go higher. So that's the immediate resistance for Keppel. Yeah, then 710 this mark probably will be a key zone to watch out for. Then for the immediate support wise, I think it will probably be this 675 level, which was a key level that we broke down off and then we reclaim it over here, which was also the opening price of the strong candle on Friday. So that's for Keppel. Okay, then Jardine, we broke down of this strong uptrend channel over here. So resistance wise, probably this key 3130 level, which was a swing high twice over here before it broke out, and we actually broke down below this level for now, which is also the channel resistance over here. So that's the immediate resistance, maybe 3160. So 3160 over here, 3130 to 3160, probably the immediate resistance. I think the immediate support, if this swing low holds around 29, close to $30 over here. But if you go lower than that, maybe we'll be looking at around 2870 around there. So maybe 2870, which was another key level to watch out for Jardine. Okay, then Hong Kong Land still remain buried after we broke down of this major trend line support. So currently we sold below this another swing low level near 395. Okay, so let's see where we can go. So the next level, if you keep on going lower, then maybe around 360. So that's 78%, Fibonacci retracement level, which also meets with this previous swing high around 360 over here. So 360 is a level to watch out for. Yeah, that's for Hong Kong land. Immediate resistance will be this near the $4 mark over here, where it was a swing low that it broke down off, and also gap resistance over here. A dairy farm. Okay, I think the immediate support wise probably near 188, which was the previous historical level last time. For immediate resistance wise, still very bearish. We actually broke down all this swing low, this green color support zone. So that's around 220 near 226 to 240 level. So that's the first immediate resistance for dairy farm to look at. ANZ. So for ANZ, I think for now the resistance probably lies around at this level, probably 2590 to about 2730 area. So over here we saw long time it acted as strong resistance over here, which we didn't break out of. And then recently we had a retest of $26 over here, which was a 70.6% level. That's the immediate resistance. Then for the support, probably this level, which is the 50% mark, and then the swing high over here. We had some swing low and swing high over here. So this is a key zone to watch out for, 2360 to about 2430 level. That will act as immediate support for ANC. Then Flight Center, I think the immediate support we have reached it just recently, which is this zone where we tested a few times over here. So there was a recent retest over here, which was near 1360 to 1460 zone over here. Then for the immediate resistance, I think likely we are probably will see around the 50% mark, $18.60, where we also see there's a lot of swing highs being made over here, but price didn't go higher. So can see that selling over here taking place near $18 to $18.60 onwards over here. So that's for Flight Center. Okay, I think I'll just answer one more before I hand over my time back. So for Hang Seng Index, okay, Seng Index. Okay, Hang Seng, I think it's better to look at the longer time frame. So there's actually this trend line over here that dates back to around 1998, long-term support line, which was broken just recently last week after the CCP meeting. So that could be a bearish sign. And we also broke down of this swing low in 2011. That's about 16,000 300 points for HSI. So I think if the drop continues, right, the next key support level probably near the 11,000. I think could be near 11,000 mark over here. So the sign around there, which was the two swing lows being formed over here. If these are longer time frame. For immediate resistance wise, probably would be this 18,200 level over here, which was a swing low that we broke down and retest and continue the selling over here. Yeah. So that's for Hang Seng. I think I'll pass on my time to Paul for any closing remarks.
Yeah, I think we still got quite a lot of questions. We just take a very quick 5 minutes just to clear up as much as we can. Then we try to end it. Also, sorry, no, we. Okay. Hi, Paul, Darren. Do you prefer Raffles Medical or Parkway REIT? For us, we still prefer Raffles Medical. I think we have a buy call on Raffles Medical. I think they came up with the third quarter update this morning. I think the earnings was probably up about 30+%. One of the reasons is because they are benefiting. I won't say benefiting, okay, but because of the shortage of capacity in the government hospitals. So some of it will flow into their hospitals and also some of the facilities they set up for the authorities. And because of the pandemic, the number of cases are still high. So they have to keep these facilities. I've slipped my mind the name of the facilities, but these are facilities set up for the government for COVID-19 patients. The treatment facilities, COVID-19, the CTFs. So and they're also benefiting from the rebound in medical tourism. So they're getting, the reason we were in negative early this year was because we thought they will completely lose COVID-19 revenue, but that's not the case because I guess the cases are still high here. So they're benefiting from these two sources of income, a lack of a better word, and also public hospital capacity shortage. Hi, Paul, when's the best time to buy SGT bills? I think we are just going to follow the Fed futures curve. Futures curve means what the market thinks the number of hikes that's coming up, which we think might probably peak in March. And because the Singapore T-bills and probably the Fed funds rate has like a 90% correlation. So it's not rocket science, we're just going to follow that. So if you think that, then that means the peak of the rates most likely will be either first quarter of 23. So we think T-bills will still continue to climb because it's another at least 150 basis points hike coming up the next 3 months or 4 months. Yeah. So it hasn't peaked yet, the T-bills. Yeah. Okay, I try to answer. There's one. Okay, I think one last one before we hand out to the rest. I'll try to clear up as much because still a lot. Will the meeting from the FOMC this week after the market affect the market, or they already priced in the interest rates? Sean, you want to do this?
Yeah, sure. On a question on whether will the FOMC this week affect the market, in general, the market has already priced in for a 75 basis point hike this meeting. However, if during the meeting, which is this week, the FOMC determines that if there is a larger hike necessary and introduce, let's say, probably 100 basis point hike, or perhaps sounds even more hawkish than before, then most probably it will definitely cause a move in the market. Yep.
Yeah, so it's going to be, a lot of people will focus on this guidance. Yeah, so it's probably how they're going to guide for December. Yeah. He's like we mentioned earlier, he's probably just going to say we're data dependent. Then the press will keep on pressing him until depending whether he relent and say that maybe we might have to wait for the effect, and there's a lag effect, so maybe we might pause. Anytime he say pause, then the market might move. Then, but again, this is just a short term. It's like again, this is like front running the Fed. It doesn't mean the economic conditions will improve or whether inflation has actually improved. Or none of it has actually happened. It's just, like I said, just trying to be ahead of the curve, of the Fed curve as well. Let's take one more on the impact of interest rate on FANG stock, and then one more on IFAST. Then I think we can kind of end it.
Sure, Paul. Okay. Yeah, so what is the impact of US interest rate on bank stocks? So, okay, first of all, we start with the valuations. Obviously, when your interest rates rise, then your valuations will decrease a little bit because you have to account for a higher risk-free rate. So it brings up your WACC, with the average cost of capital, conversely brings down your target price. But in reality, because a lot of the FANG companies don't really need to raise a lot of capital. They don't really have that much debt. At the same time, a lot of their debt has already been fixed at a lower interest rate. So they aren't really that dependent on whether interest rates move up or down that significant. Yeah, but mainly because they don't have that much debt compared to how much equity they have and how much cash flow they generate. Yeah. Thank you.
Yeah, I'll take the IFAST one. So someone, I think it's more of a comment. I'm holding IFAST at the loss, and in order to take back my capital, looks like I have to hold for a longer term till Hong Kong e-pension and IFAST Global Bank UK starts making profit. Yeah, I think you hit the nail on the head there. Yeah, you're right. So they're thinking quite long term, IFAST, I mean, from their calls as well. So the e-pension thing will definitely contribute quite positively to their bottom line. And as well as IFAST Global Bank, I mean, they are still, I think they've said that they are expecting for FY22 this year. They are, I mean, it's still trying to it's still incurring startup losses for this year. So they only target to achieve profitability for the bank starting 2024. So I think, yeah, you said from 2024 onwards, they should be reaching the four main goals, and that's why they are incurring all these losses. And I think don't forget also they had to their India business. I mean, they left, and then there was a big impairment charge on that. So they're trying to make it back for that as well. Yeah. So I think it's more of a long-term play. Yeah, I think Paul, I can hand it over to you.
Yeah. Okay, I think we probably have to end it. This one, hi Paul, UK appears to be in serious decline post-Brexit. What should we be looking out for the policies of the new PM and new Chancellor? Yeah, not sure how it's all about what is whether he wants to take any pain. So if he actually they're probably caught in a very difficult situation. If they don't take any pain to the economy, then the bonds are going to be sold down. If they take any pain in the economy, also the markets just the public may not kind of accept it out. So not sure how they're going to resolve this thing. Yeah. So sorry, I don't really have a answer. Most likely they probably need to tighten monetary conditions, just raise rates, and then hopefully the pound won't decline. But then just have to take the pain. Like all of us gone through it. I mean, the Asian financial crisis, we also did the same thing. So I'm not sure what's so special. You can't take the pain of a slowing economy. You just have to go through it. Yeah. Okay. I know. Can you flash the community slide? I know we still got lots of questions. If you do have questions, just join our P3 community, and then you can just post the questions there, and we will respond to you. So that is one of the ways where you can join our P3 app and then just join the community. Just how we take some of the questions these days. So sorry we can't answer all, and just wish everyone a good week ahead, and thanks again for your time and your questions. Yeah. Thanks. The recording will be on YouTube, but it's not on Stocks BNB, but it's also on, yeah, both are actually. Yeah. Thanks everyone. Okay, bye-bye.